Your business can be turning a profit, but still be technically insolvent. One document shows you exactly why, but most professionals never read it until it's too late. A balance sheet is a snapshot of everything a business owns, everything it owes, and what's left over for the owners, all at a single point in time. That's it. It's not a record of sales or expenses over a period. That's the profit and loss statement. The balance sheet is different. It tells you the state of the business right now. The structural logic behind it is just one equation. Assets equal liabilities plus equity. Every balance sheet in the world follows this rule. And if it doesn't balance, something is wrong. But once you understand those three terms, you can read any balance sheet in just minutes. Assets are everything the business controls that has value. Current assets are things you expect to convert to cash within 12 months. It could be stock, or debtors, or cash in the bank. Non-current assets are longer term, things like equipment, property, vehicles. Liabilities are what the business owes. Short-term liabilities are due within 12 months. And this is where UK businesses often get caught out. VAT payables and corporation tax reserves sit here. They don't appear on your profit and loss statement, so a business can look profitable on paper while quietly building up a tax bill it can't actually pay. Long-term liabilities are things like bank loans due beyond 12 months. Equity is what's left once you subtract all liabilities from all assets. It represents the owner's stake in the business. Positive equity means the business is worth something. Negative equity means that liabilities exceed the assets. And that is the definition of technical insolvency, regardless of what the P&L shows. So the P&L tells you whether you're making money, the balance sheet tells you whether you're solvent. Let's take a small UK bakery as example. It has equipment worth £20,000, stock worth £3,000, and £5,000 in the bank. Therefore, total assets are £28,000. Now, the liabilities. It owes £8,000 on a business loan, has £4,000 in VAT payable this quarter, and has set aside £3,000 for corporation tax. Total liabilities equal £15,000. Therefore, equity is £28,000 minus £15,000 to equal £13,000. The business is solvent. But now imagine that bakery hasn't set aside corporation tax. The liability is still real. HMRC still expects payment. The balance sheet would expose it immediately, but the P&L wouldn't. And that's the gap that catches businesses off guard. Profit is not the same as solvency, and the balance sheet is the only document that shows the difference. So, here's a practical reading framework. 3 checks in order. First, do current assets cover current liabilities? If your short-term assets are lower than your short-term obligations, including VAT and corporation tax owed, the business has a liquidity problem, even if it's profitable. Second, is equity positive? Positive equity means the business has net worth. Negative equity is a red flag. And for a UK limited company, directors have a legal duty to act when insolvency is a real risk. Third, are short-term obligations manageable? Look at what's due within 12 months. If there's a large loan repayment, a VAT bill, and a tax liability that all land in the same quarter, cash flow could collapse even if the business looks fine on paper. So run those 3 checks and you have a working solvency read in under 5 minutes. No accountancy qualification required. If that was of value, subscribe to the channel for one real business question answered every video. For the same clarity in writing, the website and newsletter is 5minutebusiness.com.